Hi everyone, welcome back to my channel. My name is Rishi, and today we're going to do a capital budgeting question. Let's have a read through of the question. ABC Limited is considering a 3-year investment project. The firm must purchase a machinery today for 600K. The machine will depreciate on a straight line basis over 3 years and will have no salvage value at the end of the project. The project is expected to generate revenues of 500K in year one, 550 in year two, 600 in year three. Cash operating costs are provided to us as 200K, 220, and 240 in the next 3 years. The project requires net working capital equal to 10% of next year's revenue. Net working capital is fully recovered at the end of year three, which means that the net working capital is going to be zero at the end of year three. The firm's tax rate is 30% and the appropriate discount rate is 10%. We need to calculate the project's free cash flow and compute the project's NPV. Okay, so that's the question. Let's try to solve it on Excel itself. So the capex in year zero is $600,000, correct? And I'm going to put a negative sign to make sure that it represents cash outflow. Okay, and the revenue is going to be 500K, okay, 550, and 600,000 in the next 3 years. Okay, just let's double check it. 550, and 600. The costs are going to be 200, 220, and 240. Okay, the costs are going to be, and again, a negative sign because these are costs. 200K, 220K, and 240,000. Depreciation. Okay, we have a capital expenditure. We bought a machinery for 600K. Its useful life is 3 years. So the depreciation that we're going to have every single year is going to be, so let me write here, useful life. It is 3 years. So the depreciation per year is going to be the amount of money that we spent to purchase the machinery, divide that by the useful life. Okay, so depreciation expense is going to be $200,000 every single year. Okay, I'm just gonna this. So let's calculate our earnings before tax. It's simply going to be 500K minus the 400,000. So I can use the sum function here, alt equals, to calculate the earnings before tax for each year. Now the net income is simply the earnings before tax minus tax, or we could simply say 100,000 into 1 minus the tax rate. Okay. The tax rate that's given in the question is 30%. Okay, 30%. Net working capital, okay, the discount rate, we're going to fill that out later, but the tax rate is 30%. So on 100K net income, we're going to pay $30,000 taxes, which means, oops. So we would have $70,000 worth of income. Not sure why. Okay, let's this. So we get after-tax income of, let me just redo this into 1 minus the tax rate. Okay, make this an absolute reference. Okay, so these are our net income for the next 3 years. Let's calculate the net working capital. Okay, the question says the net working capital is going to be equal to 10% of the next year's revenue. So I'm going to put 10% here. It's going to be 10% of next year's revenue. For year zero, we're going to do 10% multiplied with next year's revenue, which is 500K. Yeah, I'm going to make this reference absolute again, because it's going to be the same thing for the next 2 years. But in the question, it explicitly says that net working capital is fully recovered at the end of year three, which means that net working capital is going to be zero at the end of year three. So I'm going to hard code zero in. So let's calculate the change in net working capital. It's going to be simply this minus this and spread it across. Free cash flow, the formula, which I'm going to derive in our future lessons, is EBIT times 1 minus tax plus depreciation minus capex minus change in net working capital. So in year zero, our free cash flow is going to be the capex. We don't have any EBIT. We don't have any depreciation. We have a capex negative change in working capital. So since we have net working capital of $50,000 that we're starting out with, we gotta subtract that at time zero. Okay. In the years going forward, we're gonna do net income, EBIT times 1 minus tax when interest is zero, as is the case in this question. It simply becomes EBT, which is earnings before tax, multiplied with 1 minus tax, which is net income. Okay. Since interest is zero, EBIT is EBT, and EBT times 1 minus tax is net income. So we're going to do net income plus depreciation. Since depreciation is negative, we want to add it back. So we're going to do negative and then go to the depreciation cell. We're going to subtract capex, which is zero in this case, but then we got to subtract the change in net working capital, which is 5,000. Okay, so if you do the same way for the next 2 years, we would get these figures. Let's just make sure they're correct. Okay, we got our net income is 91,000. We got to add back depreciation. Okay, so that's 91 plus 200, 291. And then we got to subtract the change in net working capital. So that comes out to be 286. Now we got to find the net present value. But before we do that, we need the discount rate. The discount rate in the question is 10%. Okay, 0.10. Control Shift 5 makes it a percentage. We got a discount rate as 10%. So our net working capital is simply going to be, not net working capital, sorry, net present value is simply going to be the amount that we spent today, okay, which is a cash outflow at time zero. And we're going to add to it the present value of the future cash inflows, okay? So net present value. NPV function, one would assume would give you the value of the total project as of today, but it only gives you the value of the future cash inflow. So we got to add back the amount that we spent today manually, which I did in my first command. So we're going to do NPV. We got to find the rate, which is 10%, comma, the free cash flow for the next 3 years. Okay, the NPV of the project comes out to be 156,762, which is a positive figure. So given our cost of capital, this is a project that we should undertake. If NPV is zero or greater than zero, we accept projects. Hope you like this video. Please subscribe to the channel. And if you have any question that you would like me to solve, please make sure that you put it in the comment. Thank you.